I'd like to introduce Professor Paul Griffin, who will give today's main presentation. Professor Griffin is a Professor of Management at UC Davis School of Management and former Assistant Professor at Stanford University's Graduate School of Business. Professor Griffin has recently completed his term as Accounting Horizons Editor, a leading international authority in accounting and financial information and disclosures. He's published over 60 articles in leading accounting and finance journals. He's produced 5 research monographs for the Financial Accounting Standards Board and also 2 case books on US corporate financial reporting. So, Professor Griffin, I'd like to hand the floor over to you, and then I will return during the Q&A session.
Yes, so here we are. Hello, everybody. I'm in California, so it's somewhat early in the morning, but welcome to the webinar. The topic that we have here, Science in the Stock Market, Investors' Recognition of Unburnable Carbon, recently published in Energy Economics. How did we get into this particular topic? Came around mostly from some discussions with the ITS people, that's the Institute of Transportation Studies folks at UC Davis. So we're talking about concepts and developing ideas. And the idea came that there was a carbon budget and there was a certain amount of carbon that might be unburnable. So we decided to look into whether the market itself was recognizing some of the information that was made available on that. Before we get into that, just some background. I've done quite a bit of research on company valuations and how they might reflect emissions, and it certainly is a discount depending on the amount of emissions produced. Also, there's response to emissions disclosures, not just regulatory, but voluntary disclosures as well. And some of my other research indicates that companies' disclosure practices respond to shareholder preferences, and that's based on a geographic analysis depending on the preferences in certain geographic areas. Mostly, again, this is in the United States. The big question we have, I think Dan mentioned this earlier, that it's not clear as yet if the market is really pricing risk properly, adequately, or any of the risk mitigation activities that companies and governments may be doing. So there's still a big question, and I think it will be also a question that comes up in terms of understanding results that we have here. So we really don't know. There's even more recent studies on that in terms of whether we really understand the extent that there's over or even underpricing of the climate risk. Moving on to the next slide, which is page 3. We're talking about unburnable carbon. It's an old concept, although when I say old, it wasn't around in 2001, some of the initial IPCC reports, but certainly got a lot of new attention, and that's somewhat what we're paying attention to. As you may know, there's certainly a lot of emotion around this particular topic. And just to highlight a few of the headlines that you see here, Carbon Tracker, they talk about a stock market collapse, 30-40% of valuation disappearing because of bubble. Bill McKibben talks about the terrifying new math, talking about the carbon budget. The Guardian has been a leader in some of these ideas, and certainly more recently they talk about wreaking havoc. Al Gore, the world's on the brink, and Mark Carney, of course, talks about the potential losses that can occur, not just in the energy sector, but in a variety of other sectors as well. So we take that, but we move to at least a platform that we view as grounded in economic theory, and being empirically based, we are trying to bring to the table a limited amount of evidence on how the markets might be responding to some of the issues on unburnable carbon. The concept, as I said, is not new. These data go back a few years, but it talks about the overall amount of declared reserves. The 50 to 41 gigatons relates to world energy companies. And then you have the amount of carbon that could be burned to achieve no more than 2%, with a certain, I think it's 50% probability of not exceeding that amount. So there's very limited amount of carbon that can be burned, and we're going to run out of that very quickly. So this concept has certainly been around. More recently, and this was mentioned earlier, there's the McGlade-Eakins study, and it talks about the geographic distribution of these reserves. And you can see there that it's not even. There's an overall number out there that maybe 82% of the energy is unburnable. But when you look at the geographic distribution, it varies quite a bit. And particularly, you can see that it's heavily weighted to coal, and the numbers on oil and gas are a lot less. And one of the things you can do is you can work with the disclosures made by the oil and gas companies, because they give geographic distributions of where the reserves are. And you can actually come up with company-specific percentages of unburnable. And in our paper that we just published in the Energy Economics, you can look at a company like ExxonMobil, and the numbers there are much smaller. I think the number we calculated of their reserves is about 16%. So the 82% number is a big number, but it relates largely to coal, and it is not company specific. Also, slide number 6 talks about the IPCC assessment. And here the point we're making is that at that time, this is about 2001, 2002, there wasn't much recognition that there was a substantial amount of unburnable carbon. And if you look at the very left of that graph, you can see oil and gas. Even at the top of that, when you add together the purple, the yellow, or the blue, you can see on oil and gas, those numbers are all almost less than the projections made which would relate to that which would be burned up through a 450 parts per million scenario. And that's somewhat consistent with 2%. I'm being very broad in that sense, but you can see those numbers are a lot less. And relating to coal, we can see that's where the big problem is. If there's anything to be concerned about, it's coal, at least in 2001, and oil and gas, again, based on IPCC. So we looked at the unburnable carbon stories. The term did not really come into the sort of the collective consciousness of science and also in the media until about 2011. Of course, there was the original article by Menshausen in 2009, but the graph on page 7 just relates to sort of the measure of the amount of numbers of stories that were coming out. It's figure 5 in the paper. And you can see there that the peak of the stories was coming out around in sort of late 2012, early 2013. And again, this graph only goes to 2013, but I think if you extend that forward, there's been a lot more discussion, so the number of stories would be even greater. But our study period only goes through to 2013. The big, if I just get on my pointer here, the big bar there on the left, that was a carbon tax story that came out. A lot of articles, a lot of news media reports on that. We put that in there as a benchmark because we wanted to see if, okay, if there's a response to this carbon tax story, how does that compare with responses to unburnable carbon and or the response to the original 9,000 story, which took place in September of 2009. So those are the data points. Those are the events, the news items that we are analyzing in our particular study. Now, looking at the, just need to make my screen a little bigger here if I can. Well, don't worry about that. So what do we study and test? It's really whether the stock market might have recognized the potential loss of value to energy company shareholders due to unburnable carbon. And the hypotheses we have here is one that relates to the sort of the rational response, and that is you'd expect to see some response when the science was published, and at that time there was some limited BBC news interpretations of that particular article. So relative media inattention, but investor response to the initial news. But the lagged response hypothesis says that there shouldn't be much going on at the initial, because it's scientific, nobody understands a whole lot about it. The science is technical. but we should see much more of response, and particularly a negative response, because the news media stories were somewhat negative in the sense they were projecting some sort of energy price collapse. And also we incorporate in our study the extent to which these firms disclosed oil and gas reserves on their balance sheet, and we have that as a control variable to see if that made a difference as well. So the topic is interesting, obviously, because it relates to the carbon bubble and raises questions about the extent to which there might be financial losses. It's interesting also because it assesses whether the sort of large spate of media stories coming out in 2012-13 had any significant effect on prices. So they're certainly alarming if you read them as a consumer, but they affect investors' views. So we raise that question. Also, of course, anything that deals with information and price reaction has to incorporate views on efficient markets. So the maintain hypothesis of ours is that the market is efficient, is responding, and so we look to see whether the information actually has response at the time, perhaps that it should have or should not have, as the case may be. And it also relates to the costs and benefits of financial disclosure, because if these disclosures causing significant negative effects, that could be a disincentive for firms to make more of that information available to investors. So there's a lot of interesting aspects to this topic. As I said, it's an evidence-based approach, and we focus on the timing. Did the market respond at the time we think it should have responded? Is the direction of the response according to what our hypothesis? Well, if you look at understand the science, you would imagine it would be a negative response. What is the amount of response based on the market reaction and relative to market capitalization of firms? You can come up with sort of dollar number or valuation effect of these particular news items. And we have two different event study approaches. One's called the event day approach, the other's called the calendar day approach. I may get into the detail of that. But there are two alternative ways of looking at it. I come up with essentially the same answers, but slightly different ways. So before we have two hypotheses, rational response and the lag response. So what do we find? We'll get to the graphs and things, but just in general, the response is, the data is in support of the rational response hypothesis, and around April 30th, 2009, we're seeing, or we observe with controls for lots of other things that could be going on, about a 1.5% to 2% decline in stock prices or market valuations of the 63 largest U.S. oil and gas companies. So that's a pretty substantial amount of oil and gas wealth in those particular companies, the biggest in the world. But we look at the latest stories. Again, there was pretty much a big increase of these stories coming out late 2012, early 2013. They were certainly negative stories, but it appears, based on response, they compared very little new information. So we don't find a significant response there. However, we do find some evidence of a small but perceptible response over a longer window, allowing for 5 to 10 days for the market to digest, assimilate what the news story is about. So there's some evidence of a negative response, and that response is slightly greater for firms that disclose their reserves in the balance sheets. So here are the tables. Again, the numbers you see, this is slide number 12, the numbers you see in these tables are coming directly off the coefficients for the regressions. So table 2 is what we call the event day analysis. You can see there the Nature article produced about a 1.5% response. But when we look at the other and the carbon tax news had a material negative significant response as well. But when we look at the other news, these are all the stories, again, the 12 to 13 stories coming out in the press, almost nothing. I mean, slightly negative, but essentially very, very minor response. Although the response does pick up a little bit more negative for the firms that had the proved reserve disclosures. In a sense, what we're saying here, that investors could understand a little bit more about the impact if there were these information disclosures, which is interesting because it does relate to the value of it for the nation and informing investors about concept of stranded assets. The other way of looking at it, table 3, again, is column 4, if you're looking at the article itself. Same sort of results, not exactly the same numbers, but a negative response, significantly negative to Nature article. Carbon tax news is following in footsteps, also negative. The other stories, again, small response, crude reserve disclosures, slightly negative. But when you take the interaction of these other stories and the fact that they have crude reserve, that those two in combination have slightly more negative response. It's almost like the sum of those coefficients of the 13, 0.2 is 0.16, but that's 0.16 of a percent. That's only 16 basis points. It's a pretty small amount, whereas the Nature article is equivalent response of 84 basis points. So looking at the model, I'll go over this quickly. It's a regression model, and it's a panel based because it relates to multiple observations on a sample of, again, I think 63 oil and gas companies. The controls in there are things like the farmer fringe factors. Obviously, the daily stock price of a oil and gas company is going to be substantially affected by the percentage change in oil prices. We have that in there. We have the other factors there, and then we have the Nature publication that's around the day of that Nature publication. Then we have the different measures of how to pick up the effect of the other news stories. This is 2012, 2013 stories. We're looking at a response over up to -1 to 5 days. It's a 6-day window, and then a slightly longer response period. It's 11 days. We have other controls in there. As you can see, earnings size, environmental, and so forth. So these are the controls that we're looking at, trying to pick up things but for the response to go to carbon. Again, results, the ones we have in here that we indicated in those graphs earlier, they show to be significant in a statistical way. And so when you see those stars, the 3 stars means it's less than 0.001, and the 2 stars is less than 0.05 and so forth. This is standard sort of measures of statistical significance. We run some other tests on that in terms of if there's some sort of correlation between observations. It's called clustering, statistical terms, and we find some evidence that there is, but that's not enough to negate our results. Given the review process through energy economics, they asked us to do analysis of coal companies. So we ran exactly the same analysis on a slightly smaller sample of U.S. Coal companies, and looked at whether there was a response again to the mine highs and articles and some of these later events as well. So we found no negative response. However, think about the coal industry. It's been subject to a lot of attention a lot earlier. So it's not unreasonable that we would not expect a response around the time of the events that we're looking at, because some of that could have come earlier. Again, coal is something somewhat present for some time. So some of these things could have already been anticipated, although not specifically as an unburnable story, but in general, part of the evolution of the coal industry. You look in terms of the valuation effect of these news stories. Total market cap of our oil and gas firms is about $1.8 trillion, and you can see there of the combined effect based on the Limehouse and all related publications, news stories. It's about a 2.14% drop in market value. In terms of dollar numbers, that works out to be total amount of about $23 million. So we are picking up a negative economic impact, but it's not of the 40% number that's something saying, but it's a small but significant number, around about 2.14%. That's figure number 3. Slide number 17. Looking at slide number 18, you can see that most of that loss of the 23, the blue part, the 16.4, that's that's relating to the Nature article. So our calculation is that Nature article did have an impact. 16.4 billion shaved off these particular American or U.S. Energy companies. However, the orange in that graph, you can see there that the $1.1 billion, that's the amount that relates to the unburnable storage. Well, the 5.6 billion relates to the carbon tax, which is related to, but not directly to the unburnable use. So you can see that the $1.1 billion is relatively small amount, although again, not totally insignificant, but relatively small relative to total loss of about 18 billion when you add those three sections of the pie together. So how do we explain our findings? Well, first of all, consistent with what we call a rational response hypothesis, we see a reaction when we should see a reaction. That is when the science becomes available. Why may not we have seen a larger reaction? Well, a view is that investors consider all possible scenarios, and they consider scenarios based on climate research. They consider scenarios based on firms' responses. They consider scenarios based on innovation. Consider scenarios based on policy responses by governments. And again, in policy responses by governments, there's views there that even if you were to tax, some of those taxes collected could be shifted back to energy subsidized and to make the transition to a low carbon economy slightly easier one for them. Also, you have to take into account that there's a certain amount of carbon leakage, even if you had a fairly comprehensive taxing system, still may not pick it everything up. So those are sorts of things that rational investors would actually consider in terms of the likely response to even sort of strict or governmental regulation. We also have to consider the time it takes to transition to a low carbon economy, particularly on transportation, moving from carbon-based transportation to a very low carbon transportation. All the views suggest that that's going to take quite some time, even though some areas, in California, for example, are moving pretty quickly. But worldwide, I think it's going to take some time. The other item here is that we're dealing with large, very well covered by the analyst companies. So if there's any investor bias or media bias, it's more likely to be related to small companies with limited information. So we're not seeing that to any great degree with respect to company studies. The other item is that investors use multiple channels of information. They're not just focused on information, financial statements, or not just focused on information coming out of the media. They really do look at quite a variety of channels of information. Just on that particular point, most of you might be aware that Bloomberg now has a stranded assets calculator. So you can look at any particular company and ask questions about the extent to which the assets are stranded. So the market is actually responding by providing more information. Again, when we studied our particular topic, things like the Bloomberg stranded assets calculator were not available. Just a couple more slides, and then I'll conclude, and very, very happy to look at your questions. One of the issues that came up, and it comes up many times, is the market appreciating increased risks of unburnable carbon. Well, if we look at the study period that we looked at, that's 2012 to 2013, I graphed the credit spread for U.S. energy companies, CDS spread, and you can see there that the CDS spread over our study period was actually declining, 220 basis points, and with the end of that period, 190 basis points. So there was no alarm in terms of the credit spread market, which is quite a comprehensive and accurate measure of risk. However, if you look at the next slide, which is page 21, here's where it's interesting, because the market actually is responding to risk, but it looks like the risk that's associated with the red line, which is oil prices. You can see oil prices, as we all know, we're trading around about 100, going back a few years, and now they're trading around 20, 30, 40. And you can see that back there is a cause, a likely cause, of a very substantial increase in the credit spread, going from an average of about 200 in earlier years. Now it's trending up around 800. That's like a fourfold increase. Now, is that increase in risk, is that related to unburnable carbon? Well, we don't know. It certainly looks like it's related to the drop in oil prices, but is the drop in oil prices related to unburnable carbon? That's a very interesting and I think a question that we need to address. It's certainly not something that we had addressed in our study period because we're back in the 212, 213. But that intersection of those graphs, I think, is very, very interesting thing to look at. So just to finish up there, every study in science, of course, is subject to limitations, caveats. So first of all, we cannot rule out a carbon bubble. There could always be some news events or some collective evolution of these events which could lead to that and could relate to oil and gas companies and then could extend over a large number of years. Keep in mind our results only apply to US companies and US markets, and US stock market. As I said before, when you do the latent econ analysis, some of the US companies are relatively less exposed to unburnable carbon based on the geographic distribution of reserves. We may have underestimated the impact of news stories because we're focusing on those news stories and not other events which could impound indirectly some aspects of unburnable carbon, such as change in oil prices that could be reflective of the likelihood of policy scenarios and so forth that could change or would be reflective of the unburnable. And as I said before, new events could change the investors' calculus of what that risk is. And that could well be reflected, if you go back to my earlier slide, that could well be reflected in the increase in spreads just happening in the last several months. Final point, our article came out in late 2015, published in December 2015. And there's an interesting article, it's a blog, a reason.com blog, called Wishful Thinking, and the conclusion of that is that the writer of this article is sort of coming to the conclusion that the researchers, that's us basically, pretty much got it right in the sense that yes, there's a risk, but we have to consider the time horizon of this risk of transition to low carbon. Maybe the investors are looking at this in a reasonable way. So that's my presentation to you. I hope that you've enjoyed that. I look forward to questions. I'll hand it back to Dan, who can help me deal with